Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And let me get into today's Q&A episode. Let me start with an apology. Amit submitted this question a while ago and for some reason we missed it, but hopefully that doesn't happen anymore because we've got a different approach to making sure we're tracking these questions. So apologies, Amit, you submitted at the beginning of June and now it's October, so apologies for that. Okay, so let me give you a bit of a rundown. Amit's got, with family income's pretty strong, 170 for him and 150 for his wife, so 320 overall. They've got one child that's 1 year old, I should say. Home is in East Moorabbin, worth 1.4 for 700,000. Pretty funny, I've written about this before, but the very first property I bought was in Moorabbin. I think I paid, Moorabbin proper, by the way, I think I paid 150 for it. It's a long time ago, but anyway. They've got investment property in Hobart worth 550 with a $250,000 mortgage, and investment in Beveridge, Victoria, worth 650 with a loan about 600 against it. Super is 150 plus 125. I had to look up where Beveridge, Victoria was. That's not a good sign. The Beveridge property was a 4-bed, 2-bath, 2-car on 380 square metres. It's a new build. No prizes for guessing that. And Beveridge, just to let people know, is on the outskirts of Melbourne past Craigieburn. So, certainly almost country Victoria, I would say. It's probably not fair to say that, but, it's got plenty of land supply around it. And Amit's thinking, well, maybe this thing won't grow. Maybe I should sell it and go and buy something in Frankston. He mentioned Frankston. Average price is 850, given he's still got, 25 years to benefit from compounding capital growth. The second goal is he'd like to move into the McKinnon school zone, which is really jumping across, a little bit across South Road there in Moorabbin, and sell his current home. And so he's wondering, and I mentioned both these questions together because I think, to my mind, they're interrelated. He's got a couple of options. Sell the home. Option 2 is build a townhouse, keep one, sell one. Option 3 is build 2 townhouses and sell them both. And that's the question that Amit is asking at this time. So I guess to answer this question, the thing that I like to do is zoom out and go, okay, he's 40, well 39, let's say 40, 20 years to age 60, maybe 25, so 20 to 25 years until retirement. The best question that we can now ask ourselves is what should we do today so that we're in the strongest position by the time we get to age 60 or 65? So looking back in 20 years' time, what is the best decision that we can make today? And we need to have some context with that, right? Because we know we need to fund retirement. We know we'd like to live in McKinnon's secondary school zone, and that's going to avoid, paying private school fees, for instance, if we were to go to a different schooling route. And then what are we going to do with surplus cash flow over that time? Because obviously they've got, pretty strong incomes, so they can make significant debt reduction, but also what else are we going to invest in? I think the first one is that I would make that McKinnon home purchase as soon as possible. Now, you could do that in a couple of different ways because the child's only 1 year old. And I don't know if the plan is to go to primary school in McKinnon. It's a secondary college, so I don't know if there's a primary school there. But anyway, what you could do is, for instance, sell Beveridge. I don't think Beveridge is going to be a good investment. It just doesn't have any attributes of a investment grade property. It's possible that you'll see some growth there just because of the price point, but it's not going to grow beyond the median value because the ripple effect will happen. Why would I pay more than 900,000 for a house in Beveridge when, I can go a little bit further down the road and buy a brand new block, for instance? So I think it's not impossible to see that value grow beyond 650, but, if we're looking back in 20 years' time, then that ripple effect will occur. And because of land supply, I just don't think you're going to see the growth. So Beveridge is definitely a sell. Hobart's just obviously more recently gone through a bit of a growth cycle. Its population isn't really moving in the right direction. It's only eating into $250,000 of borrowing capacity, so it's not that big a deal. But, I don't know if you bought that property for any lifestyle reasons, but, I'll put a question mark over whether you hold on to that one as well. Then the question would be, do you go and buy a family home in Bentley, McKinnon, in that school zone now and put a tenant in it and that might absorb quite a bit of your surplus cash flow, but at least you get into the market at this particular point in time and you get some negative gearing benefits as well. That could work as a strategy, and then say in 5-6 years time you do whatever you do with the Moorabbin home, whether you develop that or whether you, in fact, you're probably actually better off just getting a DA for 2 townhouses and then selling it with a DA. But you'd need to do a bit of work on that. That is, speak to some local real estate agents and see if there's any appetite for that at that particular time. And it would only be worthwhile if obviously the numbers stacked up, and they don't always stack up. So you just got to make sure you do that due diligence, but you probably wouldn't go to the extent of actually building them. I don't think it's a lot easier, I think, and you're going to take probably half of the profit if you can get the DA and sell it with a DA, because anyone that's willing to do a project like that will be able to start straight away, and they don't have the delay and the risk associated with council and approvals. So you could always do that down the track. And then once you've done that, replace it with another investment property. But that could be a good strategy because, if we feel like property values are going to escalate in Melbourne, well, then you, over the next couple of years, you're going to keep Moorabbin. Hopefully Moorabbin still appreciates as well. And then you buy a nice property in Bentley for whatever in that school zone. And you've got quite a bit invested in the Melbourne market that hopefully will benefit from the uplift. And then also, because you're going to take on more debt, you get some negative gearing benefits associated with that. And then you can sell tax-free in Moorabbin and move on. So that could be a good strategy to consider. Alternatively, it could be sell Beveridge, potentially sell Hobart and replace it with a pure investment property. But you want to start thinking about, future debt management, borrowing capacity and cash flow, because, in the future, in time, when you do that changeover from Moorabbin into the school zone, you don't want to, it's going to give rise to more non-tax deductible debt. And also, if prices rise as well, that there's a cost associated with that, because that's going to be paid from after-tax dollars, whatever that uplift is. So in one way, you'd probably then be a little bit more conservative with the purchase price of the replacement investment property. And then if you're going to be more conservative with the purchase price, then maybe it might invite you to buy a lesser quality property. So I think that's the risk with that strategy. Now, would I buy in Frankston? Would I spend $8 to $8.50 in Frankston, or would I go and buy a 2-bedroom, older style apartment in Hawthorn or something like that? Look, I think I'd probably prefer the Hawthorn property, just given where those sorts of assets are in the cycle, as opposed to Frankston. But, that's just something to think about. But I think I'd explore selling Beveridge, probably thinking very carefully about Hobart, and then buying a property in Bentley. It might not be the home that you want to live in, but the land. It's just the land location and the land size that you should be most interested with or about, because you can always make improvements down the track if and when you move into that property. But at least then I see that as your key risk here, Amit, is being not priced out of that market, but the after-tax cost associated with the increase in property prices in that location over the next 5 to 10 years. That could be, quite a costly situation in your situation. Okay, so hopefully that's useful, Amit, and also for people that are in similar situations. And once again, apologies for missing your question initially. Okay, next question is from Ron. Ron says, thank you very much for the measured approach to matters that can easily be warped by motives and ideologies. I've really enjoyed listening to your podcast on my commutes over several months now. Thanks, Ron. I appreciate it. I try to, keep this podcast really, I'm very free over, self-promotion and those sorts of things, but also I like the saying of hold strong opinions loosely. So, have conviction in what you believe, but be open to the fact that, it might not be true anymore, or it might not have been true from the beginning, and keep your mind open. So I try and do that as much as possible. I don't consume much other content. In fact, the only other podcast I listen to is The Money Puzzle by The Australian, and just so I can keep, because I'm on there regularly, just so I can keep up to date with what's going on. But otherwise, I try not to read too much other than insights and analysis and that sort of stuff, but not like a lot of other people's podcasts, because I don't want my content to be subconsciously impacted by other people's content. So I like to keep it fresh. I like to try and make sure that, I don't just keep repeating the same mistakes. So, I keep my mind thinking about new things and not holding on to, previous ideas and so forth. So anyway, we'll see where that takes us over the next number of years, but I appreciate your feedback, Ron. Okay, I'll keep going. I'm Ron from Brisbane. I'm 42 and my wife is Sorry, I'm 47 and my wife is 42. We're debating whether we should retire. I don't have a definite retirement date, but my wife is from the Philippines and wants us to retire in the next 10 years, 15 tops. She argues that we can divide retirement time to reduce costs by living in Manila in early retirement and returning to Australia later on. I like this idea, but my only concern is that we may not be able to be in a strong position to be able to do so. We own our primary residence valued at 800,000 with 489,000 owing and 92,000 in the offset account. So really we could just say 800,000 with 400 net debt. I have a share portfolio fluctuating around $30,000 with $500 fortnightly reoccurring investment. My wife does not like the idea of stocks. I earn 160,000 per annum and have no debts of any kind. My wife earns 107,000 per annum, has no consumer debt, but has HEX debt of 42,000. We have a son that's finishing private school in 2026. His graduation will free up about $1,000 a fortnight. We're both teachers. I'm in mental management, and my wife is training to be a specialist with the potential to earn as much as I do now. The questions we have discussed: 1, do we divert the $1,000 a fortnight we've been paying to private schools into our home loan and my wife's HEX debt, or divert it into my wife's super via non-concessional contributions because her balance is just over 100,000 and mine is 348. Use the equity in our, or 3, use the equity in our primary residence and former school fees as a repayment to buy an investment grade property in Brisbane, Adelaide or Perth. Or number 4, maximise both concessional and voluntary contributions into super so as to reach $1 million in each account in the next 15 years and pay off the mortgage and HEX debt. How would you rate each of these options? Better yet, what blind spots do you see in our thinking? Okay, so the first thing that comes to mind, actually, before I start that, really the way to answer this question is I would build a financial model and I'd put all your income and expenses, assets and liabilities, and I'll model it out. I'd see how important is it to, focus on debt repayments versus super contributions versus buying investment property and so on and so forth. That's how I would find the answer to this question, because there is an answer. That is, there is just one best strategy. Typically, almost always one best strategy. Sometimes there's two that are relatively similar in terms of both risk and outcomes, but quite often there's just typically one best way. Having said that, I'm happy to make some comments, and I think after doing this for a long period of time, not always, but often, you can kind of sort of guess or foresee, which is not a good enough, foresee what the right outcome would be, which is not good enough to actually act upon because you still want to do the numbers to confirm it, but hopefully it gives you a bit of food for thought. Anyway, the first thing that jumps out at me is that the Australian government has proposed, and it's really been on the cards, I'm going to say 5 years, but it even could be longer than that, to change the residency rules, the tax residency rules, and to make them more codified. So at the moment, they're sort of entrenched in common law, so case law, as much of our law is. And the problem with that, though, is it's quite subjective in terms of whether you are a tax resident or not a tax resident. And it really depends on the facts. And there's a lot that goes into it. And it creates a bit of uncertainty for both the ATO and taxpayers. And so what they've proposed to do is come in with rewrite the law and have 3 tests. And it just means that if you are living overseas, essentially in this situation where you go into retirement and then to minimize living costs, live overseas for a period of time. And then you might think, well, I'll rent my home out and do those sorts of things. The problem if those laws come into, well, if they become law, and I don't think there's much to stop them other than they've got bigger fish to fry at the moment and that we've had COVID in between all these sorts of things. I think they will actually get round to doing it. I don't think they're going to have much in the way of pushback on it either. It just means that, you could have some adverse tax consequences. And at the moment, if you're a non-resident, a non-tax resident in Australia, you don't enjoy the 50% capital gains tax discount, which means that any growth on any property, you also don't get the main residence exemption, any growth on any property is taxed at the full rate. So it means half of your growth will be tax. And it just means from an after-tax perspective, residential property relative or compared to shares, for instance, is really tax ineffective because as a non-resident, if you've got a share portfolio, you don't pay any capital gains tax on that portfolio, and you don't pay any income tax on franked dividends either. So, that one is tax-free and the other one is taxed at almost 50%. So, it just means property is relatively unattractive to non-residents as it stands at the moment. And then the residency rules start to become problematic in this sort of situation. So that's one sort of flag. And so what does that mean? Well, it just means that if you're planning to retire and go overseas, then you don't want to be holding too much wealth in property. Or put it a different way, if you hold a lot of wealth in property, then you are open to these tax changes, which, some exist today. So that's the first thing. The next thing is really it's about trying to build as much wealth, obviously, over the next 10 to 15 years. And borrowing to invest will probably, borrowing to invest always achieves that. If you buy well and you buy into the right market. You mentioned Brisbane and Adelaide and Perth. Well, you probably wouldn't buy into either of Brisbane or Adelaide. Maybe Brisbane, probably certainly not Adelaide. I mean, Adelaide, you look at the 10-year returns in terms of price returns, and they're above average. So when you buy into a market where the last 10 years has been above average, it's a risky proposition. Now, that market might continue to run, but the chances are it won't continue to run for the next 10 years. There'll be a flat cycle there. Brisbane, I've spoken about Brisbane before. The sentiment is strong. Maybe sentiment will continue to be strong right up to the Olympics, but then it will probably take a breather. Whereas Perth is kind of only, probably 2 to 3 years into its growth cycle. So it probably has a little bit of time left. So, if you go and borrow and buy a good property in Perth, underlying good in terms of investment grade, that's likely from a dollar value perspective to generate the best outcomes for you, as opposed to contributing into super, which is ungeared. However, you've got to think about the tax, because it's possible that in 10 years' time, you have to sell both your home and the investment property just because of the tax consequences of becoming a non-tax resident. And so that's not ideal, because we want the compounding capital growth. If you have worked out that if you can make additional contributions over the next 10 years and grow both your supers to $1 million each, and I haven't done those numbers, by the way, and repay most, if not all, of the debt against the home, that's probably going to be the best strategy. Just because one, it hits your goals, that's probably enough. As I've spoken about, I did an episode, actually, it's How Much Wealth is Enough, episode 358. I got a lot of positive feedback from that episode, by the way, where I worked out $1.8 million in today's dollars. So we'd have to future value it. Will give you $120,000 a year. But if you're going to go and live in Manila and spend a lot less than that, then you probably need a lot less. So again, I haven't done the numbers, but it would seem to me that that would probably be enough, be able to hit your goals. And to me, that seems like it's going to be the lowest risk if you potentially going to become a non-tax resident in the future. But I guess what this question shows and demonstrates is something that I talk about in the podcast a lot, which is a lot of decisions are multifaceted, in that there's financial planning considerations, there's investment property considerations, shares, super, taxation, and you really need to be able to have a good holistic answer. You really need someone that's going to be able to know, kind of equal amounts about all these different things to kind of navigate those outcomes. So I'm not trying to beat you over the head with it, but, again, it's just an example that we see. I get the benefit of seeing this every day, and it's just a good opportunity, I think, these Q&As to sort of demonstrate that in a really practical way. Anyway, thanks for your question, Ron, and all the best with it. Oh, so I should say, actually, answer your question. Do you have enough to retire? Well, if you can work out, like as I said, if you work out that you can have 2 million super, 1 mil each, very little debt against the family home, and what you need to then do is bring that back down into present value. So that's about $1.5 million. So 2 million in 10 years' time is about $1.5 million today. If you're going to spend a lot less than 120,000 in the first 10 years of retirement, that's probably going to be enough. So I think that's the answer, but it just, navigating the outcomes, the taxation outcomes of the potential tax consequences of becoming a non-tax resident of Australia probably dictates which approach is the best approach for you. Anyway, all the best, Ron. Cheers. Okay, next question is from Anthony. It's a bit of a long one. I'll see if I can paraphrase a little bit. Anthony's 49, divorced, co-parenting 3 kids from 11 to 15. That sounds like fun. He doesn't intend to retire at 65. Loves what he does. He does mid-size, reasonably high-end property developments. Loves property. It's his passion. And it also gives him a really good balance in terms of being able to spend his time on other things like travel, keeping fit, reading and meeting people, which sounds great. In terms of his position, he's got a home worth 3.8 million. It's been growing at 7% per annum in terms of capital growth. Mortgage is 2.7, but 2.5 in the offset, so very little debt against it, mostly offset. And then the development company owns 2 assets. One is a house, 2.5 with 1.8 million of debt. It sounds like a pretty good property, ocean views, one of the last undeveloped blocks in its location. The other one is another house, Torrens title duplex. It must have been one that he built previously. Values 1.6 with 1.2 of debt against it. It's doing well and renting for about $9.50 per week. And then he's got another unused debt facility of 1.8 million, which he uses obviously for his developing and so forth. His questions are, he'd like to get 2 million into super by age 65 based on what I've been talking about in terms of what's the tax effective way to do that. But he's concerned about the share market at the moment being at all-time highs. And he's wondering, even if he does that, does he put it into what he's currently invested in, which is Australian Super Members Direct, specifically VGS, so just Vanguard International. And then, so that would have done well over the past couple of years, but, whether it does well, if the US share market doesn't do as well, which it probably won't over the next 10 years, then that might be an opportunity for him to improve his situation. And then the second question is, maybe he doesn't actually need to do anything with these properties. So the first property, the one that has the uniqueness in terms of ocean views and so forth, has been growing at 7% per year and rents for about $1,000 a week. And he said, well, if that keeps going, let me see, it'll be worth 5.2 in 10 years or 6.8 in 15 years. And maybe he should just sort of live off the capital growth, or that would be his strategy, is using the capital growth, and therefore he doesn't need to take money, because if he's going to move money into super, he's got to take it out of his mortgage offset, which is non-tax deductible debt, and he doesn't like the idea of that, so maybe that's the strategy. So that's me paraphrasing what is a really long email. Okay, so what would I be thinking about here? Because there's a bit of nuance here in terms of getting money into super. And, if you had a clean sheet of paper, you'd go, okay, well, let's just contribute, $30,000 a year for our entire working life. And that way, by the time I get to retirement, I'll have 2 million in super, 2 million in today's dollars or whatever it might be. And that might be mathematically perfect, but, it doesn't suit everyone's circumstances, and contributing money into super when you're really young also doesn't make a whole lot of sense. So that's where the kind of nuance sits. Also, then what makes it really difficult is if you've got existing assets, because if you're holding existing wealth in other assets, then you've got to face the situation of what do I do with that? And so getting money into super is only one of many considerations. So it shouldn't just be the sole end game. That said, it's a tax-free environment. So my argument would be, why would you pay tax outside? If you're going to get a 50% discount on CGT, then you're going to be paying about 23.5% at the most. And when I've done my calculations, it's about 20% because of marginal tax rates. So outside, you're paying 20% of growth in tax, whereas if you've got that growth inside super, you're not going to pay any tax. So it's not the end of the world, but, there is some benefit of getting money into super. In Anthony's situation, what I would think about is he's 49, so I wouldn't really, and he's got younger kids, so I'm not in love with the idea of taking money out of non-tax deductible offset to put it into super just so I can have more money inside super. So I don't like that idea, but I don't think the answer is ignore super completely. So this is the thing, right? There's not a black or white situation. So if I was in Anthony's situation, what I might do is say, well, I'm going to contribute, say, at least 50 grand a year into super, which is 30 of concessional and then say 20 of non-concessional contributions, but 30 overall. I might do that first obviously the 30 that's concessional contributions is tax effective, and at least I'm getting some money in there, but I'm not putting a huge amount. If I do a development, in the year that I do a development, I might maximize my caps. So I'll put 120 of non-concessional and then 30 of concessional, so 150 in 1 year. So that's the year when you do a development, just again, so you can drip feed that money inside. But apart from that, I probably wouldn't do too much. In terms of Anthony's asset base, I don't think he needs to do a whole lot right as long as he doesn't do anything wrong. That is, it seems like the property assets that he's got will do their thing over the next 10 to 15 years, and that will be enough. If these assets are owned inside a company, which is going to benefit Anthony because when he sells those assets, or if he sells those assets when he transitions into retirement, he'll pay tax at 30%, but he'll get a credit for that. And so then what he can do is pay out a dividend out of that company each year, get a credit for the tax already paid, and then make those contributions into super. Now, he might do, a whole lot of contributions, bring forward, carry forward contributions and so forth when he does transition to retirement, but I think it's okay. I think I wouldn't be too worried about it for the next 10 years because it's possible that if he sells it at age 65, at least he quarantines the tax liability in the company, gets the imputation credits from the tax paid, and then he can drip feed that money into super between age 65 and 75, for instance, and it's still going to be relatively tax effective just because he's got that company. Whereas if it was in personal names, he's going to crystallize a really large tax bill in one particular year, gets no credit for the tax, it is what it is in that particular financial year, and then he has to get the money into super. So if I was in Anthony's position, I don't think I would be too worried too much about getting the money into super. Sounds like he's heading in the right direction. If he does a few more developments over the next 10 years, that'll add to successful developments, that'll add to the portfolio and add to his cash position, all those sorts of things. I would still make contributions each year regularly, like with discipline. In the years that, as I said, had a much better year from a development perspective, put some more in. And, over the next 10 years, I think you can grow that balance without having a major impact on your offset balance. And then you can start thinking about how you get the equity in the company, in those two properties in the company, into super eventually. In regards to your current super, Australian Super Members Direct all in VGS, I've spoken before, about the concentration risk in the US stock market, particularly in the top 10 companies. It'd be stupid to say technology is not going to play a role in the economy over the next 10, 20, 30 years, and that AI won't play a role. I think it'll play a very, very big role, but it's not really growth at any cost. It's growth at a reasonable price, I think. And at the moment, it's growth at an unreasonable price, which means that I'd be concerned about VGS. I think you might be just better off transferring into Aussie Super and let them manage the asset allocation. They'll be well aware of that risk. Their asset managers would be, and they'll be doing things to sort of accommodate that risk. So I think whilst it's very low cost, I don't think, you've got 350 of super. It's not critical because you've got most of your wealth. It's only a small part of your wealth. But if you're making additional contributions, what you're doing is putting additional capital into a market that is relatively high. I don't think I'd like to put that into VGS, or not all into VGS, and you might be just better off using their growth premixed option or something like that. Anyway, Anthony, I hope that helps, and thanks so much for your question. Okay, the next question is from Steve. I might park that, probably address it tomorrow as it's a bit of a long one, and I might leave it there for today. Thanks for listening, and I'll be with you tomorrow. Tomorrow I'm going to talk about how population growth is often cited in terms of having impact on property price growth. And if we're sitting here, we're wondering, what will markets do over the next period of time? So the next few years, where are property market cycles? And, will Adelaide, for instance, keep growing, even though it's grown substantially or above average over the last decade? That's a key question, right? And so tomorrow, I want to talk about an evidence-based way of making that assessment. I think there's one particular metric that I think trumps all other metrics because it reflects the overall sentiment and all the other drivers, including population growth. Anyway, I'll talk about that tomorrow. Until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.